Did you know that more than 50% of Americans feel behind on their retirement investments, not just because they're under contributing to their retirement, but because they're having a hard time understanding the investment options, fees, and rules for their 401k, Roth IRA, or taxable brokerage accounts? I don't blame them because the government doesn't exactly do a good job explaining how they work, or if they even try to explain them at all. And not everyone can afford to pay financial advisors thousands of dollars in fees to give them proper investment advice. The United States of America is the #1 richest country in the world, but 60% of its people express that money is their #1 stressor, and people are making some of the worst investment mistakes that could delay their retirement. And mistake #1 is letting your emotions get in the way of how you make decisions on buying or selling your investments. When the market was down by 20, 25, or 30% in 2022, all we got was an endless negative news cycle about the bear market, the Fed raising interest rates, and how the egg prices were at an all-time high. And the only way to succeed your dating life was to bring a dozen of eggs to your date. And take a look at this white paper from Nationwide. This is how the news influenced the S&P 500 index from 1986 to 2022. The market dipped every time something major happened on the news and made a recovery from every major dip. And sometimes the dip takes a year to 2 years. The dot-com bubble burst in the 2000s was probably the longest bear market for about 2.5 years. When 9/11 happened, the market dipped more and longer, which created a longer time before it started to recover in 2003. The more severe one we saw was in 2008 during the financial market crisis. And I still remember when it happened because there was an endless news cycle about the complete collapse of the US economy. The S&P 500 actually finished with almost a negative 46% from October 2007 to March 2009, and that was an 18-month bear market that people didn't even think was ever going to recover from. And people panicked and sold again at the beginning of the coronavirus pandemic, but they missed all of the recoveries from each bear market. And so many people get caught up in this vicious news cycle. Just because your retirement investments are down 10, 20, 30, or 40%, it doesn't mean that you should just sell out your investments with a 30% loss. You don't lose money until you sell your investments. But the sad news is that many people sell those investments anyway. And let me tell you this, if the S&P 500 ever goes to zero, that means it is the end of the United States as we know it. The S&P 500 going to zero means that Apple, Microsoft, Amazon, Nvidia, Google, Meta, Tesla, JP Morgan Chase, and other large companies just completely collapsed. Do I plan my investments around these bad news cycles or one bad news article about the collapse of the US economy? No, I've learned to tune them out and only pay attention to the analysis. And the market timing has so much to do with poor investment performances. I don't buy and sell investments every day. I'm not a trader. I just buy and hold for the long term. And take a look at the growth of $10,000 in the S&P 500 index from August 2002 to August 2022. If I keep it fully invested, I would have $46,000. It would be a lot more now in August 2023 because the S&P 500 has increased by another 15.6% at the time I'm recording this video. I just continue to buy and hold. Just by missing the 10 best days in the market, your portfolio would be down from $46,000 to $21,000. Missing 20 best days, your portfolio would be down to $12,000. Missing 30 best days in the market would put your portfolio below $8,400, which is a 16% loss from the original $10,000 investment in 20 years. The best strategy is to stick with investments for the long term. Tune out the noises from the financial news media and maintain a diversified portfolio. Every time there's a dip in the market, I'm going to take advantage of it. And mistake #2 is that people are buying high when the market is up and selling low when the market is down. Buy low, sell high has always been the common motto in the investment world. But many people do the exact opposite. I'm going to show you why by using the VOO index ETF as an example, but please keep in mind that I'm not here to give you any form of financial advice. I'm just going to show you what the data tells me. Last year, the S&P 500 finished 2022 down by negative 18%. At one point, it was down as much as 22 or 23% in the year when I constantly pushed videos out about how cheap the stock prices were in 2022. People in the comment section were telling me that I was catching a falling knife and that it was the end of the US economy. The videos I made back in September and October got some of the most dislikes because they thought I was dumb to keep buying stocks when the market was at a 52-week low. Isn't the whole point of making money in the stock market is to buy low and sell high? To this day, there are people who still hold money in cash and refuse to invest because they're fearful of the market. And I just continue to buy shares when the market was down because I focused on the long-term plan. Why are you panicking when you're not even looking to touch your 401k or Roth IRA for another 25 or 30 years? And people who stay put for the long term always comes out with a win. And take a look at this. I didn't truly start investing until late 2016. In 2017, the fund performed a 21% return with dividend reinvestments. In 2018, the market was down by negative 4% when the Federal Reserve raised interest rates out of nowhere. Did I panic? Nope. I bought even more shares. And because in 2019, the market made a huge comeback with a 31% return when the Feds cut interest rates. In 2020 was when the market tanked during the economic shutdown in March and April. The market still made a comeback by finishing with an 18% return because of the stimulus checks and the Feds lowering interest rates to 0%. But what did I do in March and April of 2020? I bought a ton of shares. And look at 2021, another bull market year with a 28% return. You have to remember that the historical data shows more bull market years than bear market years. And don't forget that you can download all of my financial resources for absolutely free by visiting firesightchat.com/resources. You should also check out my Fireside Chat shop if you're curious about what equipment I use to grow my YouTube channel from 700 subscribers to 10,000 subscribers in a year by visiting firesightchat.com/shopping. And mistake number 3 is paying too much attention to short-term performances and not the 5 or 10-year performance charts. When I invest in mutual funds or ETFs, I always pay attention to the 5 or 10-year performances. Since 2010, VOO has performed almost a 14% average annual return. That's 14% every year on average. In the last 10 years, it's performed a 12.6% average annual return. And people get so hung up on the current share prices, while many would say something like, I wish I could get into a time machine and start investing 5 or 10 years ago. I started in 2017 when the VOO share price was just under or around $200 a share. And you know what people told me back then? The S&P 500 was overpriced. Now the share price is over $420. And I didn't predict the future or anything, but I continue to invest because I believe in the long-term growth of the US economy. And take a look at 2021 and 2022. The bear market really started in November 2021 when the share price was around $419. If you look at today's price, it is sitting at around $420. So if I just stopped investing in November 2021, not counting any dividend reinvestments, I would just be breaking even right about now. My $10,000 investment from November 2021 would just be around $10,000 in August 2023, right? But what I really did throughout the year was constantly dollar cost average my investments. I bought shares every single week at a discount from $413 a share and to as low as $327 a share. And that's how I got 10%, 15%, and 20% returns from the shares that I purchased throughout the year. So instead of viewing stocks being down 20% for the year, I view it as a 20% discount. And if you're interested in finding out about your eligibility to join my private client program, you can schedule a free 20-minute session with me by visiting firesightchat.com/coaching. And mistake number 4 is paying way too much in investment fees and commissions. I'm gonna show you a list of Vanguard mutual funds as an example. Take a look at the first mutual fund, VMNFX. And that is the Vanguard Market Mutual Fund Investor Shares. And I don't know anything about this mutual fund, but I can tell you just by looking at it that if the mutual fund performs a 7% return this year, almost 2% of that will be taken out and paid to the mutual fund managers. So your net return is probably only around 5%. Your fees and costs to invest in any mutual fund will have a great impact on your investment portfolio. So first, you need to find out how much your broker is charging you in plan fees, which is how much it costs to keep your brokerage account open. Second, you need to know how much you're being charged for investing in whatever mutual fund you choose to invest in. I have seen certain actively managed mutual funds that charge you as much as 2% in annual expenses. So don't just look at the overall performances, but take a look at how much you're being charged for just investing in it. The mistake number 5 is not understanding the proper withdrawal rate of your investment portfolio while you're investing for financial independence. Your withdrawal rate should entirely depend on your balance and allocation. I know you're working hard to invest in your retirement portfolio, like your Roth IRA, 401k, or TSP. You need to actually start doing some stress tests on your portfolio to find out if you can survive on $500,000, $1 million, or $2 million. So for example, if you have $500,000 investing in your 401k, the 4% withdrawal rate will be $20,000 a year. $1 million invested in your Roth IRA will be $40,000 a year. And $2 million invested in your HSA will be $80,000 a year. However, just because you have $2 million invested, it doesn't mean you should make a 4% withdrawal every single year. Because what people really forget to do is to calculate their other income sources like Social Security pension income, real estate income, or dividend income. You have to account for your other income sources before deciding on how much you want to withdraw from your investment account. You might be able to just live on a 3% withdrawal rate from your portfolio if you have a higher balance. Maybe you just need a 3% withdrawal rate if you have a high pension income. You might only be able to live on a 2% withdrawal rate if you have more bonds than stocks going into your retirement. A lot of people make this mistake by waiting until their retirement to figure out their withdrawal strategy. You should be planning that right now. I hate to even say this, but I believe that the lack of financial literacy is going to continue to negatively impact Americans both at home and in the workplace. I'm a financial coach and I can educate you on the basic fundamentals of investing because that's what most Americans need right now. And I can tell you from my experience that nobody else, not even the government, will give a crap about your money more than you. You have to take control of your finances so that you can take control of your own future. And if you want to know more about how to maximize your retirement contributions so that you can retire early, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe and I hope to see you in the next video. Have a good one.